Welcome to the first video of this corporate finance course series. So in this video, I will do a quick introduction to this fascinating area in finance. So for those of you who are new to this area, I'm sure you are curious about what corporate finance is. So corporate finance has three main areas of concerns. First of all, what long-term investment should the firm take on? We use the term capital budgeting to describe the process of making and managing expenditures on long-lived assets. Secondly, where will we get the long-term financing to pay for the investments? Specifically, where should we pay for how should we pay for our assets, and should we use debt or equity to pay for it? This question involves the firm's capital structure, which represent the proportions of the firm's financing from current and long-term debt and equity. The third question is about working capital management. How should short-term operating cash flows be managed? So in a firm, we need financial managers to monitor day-to-day finance activities. So what is exactly the role of a financial manager? In fact, the owners or the stockholders are usually not directly involved in making business decisions. Instead, the corporation employs managers to represent the owner's interest and make decisions on their behalf. The finance activities in a firm is always related to the top financial managers, such as the chief financial officers. Reporting to the CFO are treasurer and controller. Treasurer is responsible for cash management, credit management, capital expenditures, and financial planning, whereas controller oversees taxes, cost accounting, financial accounting, and the data processing in the firm. So here is a graph representation of the organizational structure. We can see CFO, treasurer, and controller in the chart. Below them are some lesser officers. Okay, so the firm is a way of organizing the economic activity of many individuals. A basic problem of the firm is how to raise cash. Organizing the firm as a corporation is the standard way for solving problems encountered in raising large amounts of cash. However, business can take other forms as well. So here I would like to introduce three basic legal forms of organizing firms. The first type is sole proprietorship, which is a business owned by only one person. There are some pros and cons. The pros of sole proprietorship includes it is the easiest and cheapest to start, and it is the least regulated by the government. Also, the single owner keeps all the profits, and income is taxed only once as individual income, and the owner does not need to pay corporate income taxes. Also, there are several cons. Sole proprietorship has unlimited liability, which means that whatever personal assets you have is also the business assets. And the life of the sole proprietorship is limited to the life of the owner. In addition, equity capital is limited to the owner's personal wealth, and there is some difficulties related to selling ownership interest and raising large amounts of capital. The second type is partnership, which refers to a business formed by two or more individuals or entities. There are two categories: general partnership and limited partnership. It is different based on the composition of the types of partners. So you can see the definition below. Some advantages of partnership include it is inexpensive and easy to form. There are more capital available because there are more individuals involved. And similar to sole proprietorship, the income generated is taxed only once as personal income. Some of the disadvantages include general partners have unlimited liability, and general partnership is dissolved when one partner dies or wishes to sell. Also, there are some difficulties related to raising large amounts of cash and transfer ownership. The third and most important business organization type is corporation. It has a key feature that stands it apart from the previous two types, which is the separation of ownership and management. So, what does it mean? There are three sets of distinct interests in a corporation: the shareholders or the owners, the directors, and the corporate officers or the top management. Traditionally, the shareholders control the corporation's directions, policies, and activities, and they elect a board of directors who in turn elect top management. Although there may be a large overlap among the shareholders, directors, and top management, there are still potential separation of ownership and management. This feature leads to a couple of advantages of corporation. First of all, it has limited liability, and the corporation has unlimited life. The transfer of ownership is easy, and it is also easy to raise capital compared to the previous two types. However, the disadvantage is also obvious. It is the most complicated to start, and there is a major disadvantage of double taxation. It means that income is taxed at the corporate tax rate, and then the dividends is taxed again at the personal tax rate. Okay, moving forward, I want to discuss the goal of financial management. If I ask you this question, the answers may vary from maximize profit, maximize cost, maximize sales or market share, to avoid financial distress and bankruptcy, or maintain steady earnings growth. However, each of these possible goals seems problematic. The financial manager in a corporation makes decisions for the stockholders of the firm. So we need to answer a more fundamental question. From the stockholder's point of view, what is the good financial management decision? It turns out that the appropriate goal for the financial manager is to maximize the current value per share of the existing stock. We know that the stockholders in the firm are residual owners. Therefore, if the stockholders are winning in the sense that the leftover residual portion is growing, it must be the case that everyone else in the firm is also winning. So at this point, if we're taking a step back, a more natural question is, what should be the appropriate goal when the firm has no traded stock at all? The answer to this question leads to a more general goal. Since the total value of the stock in the corporation is the same as the value of the owner's equity, a more general definition of the financial management goal is to maximize the market value of the existing owner's equity. In the last part of this video, I would like to introduce the principal-agent problem. It is the heart of corporate finance. So agency problem or principal-agent problem arises because of the separation of ownership and control, which we've introduced in the previous part of this video. The agency relationship occurs when principal hires an agent to represent his or her interests. In our context, we can think of when the stockholders hire the managers to run the company, an agency relationship occurs. The agency problem refers to a conflict of interest between principal and agent. The agency cost can be both direct or indirect. Direct agency cost comes in two forms. The first type is a corporate expenditure that benefits management but is cost to stockholders. And the second type of direct cost is an expense that arises from the need to monitor management actions. Indirect agency cost is a lost opportunity. For example, management avoid taking risky new investment that is expected to have a favorable impact on the company's share value. This is because there is a chance that things will turn out badly and the management will lose their job. So if you're interested in agency problem, I highly recommend you to take a look at this YouTube video. I think it is a very simple and intuitive illustration to agency problem. Okay. So whether managers will act in the best interest of stockholders depend on two factors. The first is how closely are management goals aligned with stockholder goals? And secondly, can managers be replaced if they do not pursue stockholders' goals? In fact, managerial compensation and the threat of replacement can incentivize managers to act in the interest of stockholders. So there are two ways to manage agency conflicts as a result. If we tied managers' compensation to the company's financial performance, we can align the interests of management and shareholders. For example, the stock and options grants are often used to motivate employees of all types. Of course, the incentives need to be structured carefully to make sure that they achieve their goal. In fact, the proxy fights could be used to replace existing management. In this video, I introduced the big picture of corporate finance, 3 types of business organization, the goal of financial management, and a very important problem in finance, which is the principal agent problem. In our next video, I will talk about a very fundamental valuation framework, the discounted cash flow valuation model. So I hope you enjoyed this video, and I will see you soon.